Novartis 4.5. L'Oreal was 24 down. Nestle 23%.
L'Oreal, because you're worth it. You're a big David Ginola fan, aren't you? That's a reference
do they
from the
use
90s.
that shampoo I used to go? It's called Wash and Go.
Wash and Gone. Oh dear.
Why am I always the buck of every show?
I don't know. I mean, it's
not fair, is it?
It's not fair. It's amusing though.
I am worth it though. Is it L'Oreal that's worth it?
L'Oreal, because you're worth it.
Don't know.
I think it is.
Don't know what
There's no point
is.
looking at Alex, is it? He was born in the noughties, probably.
And he's got lovely hair
45,
as well.
right? He has flowing locks.
Very good.
Refreshed from his trip to Italy and Croatia.
Thank you for my pink vodka.
It's nice. It's not
very
vodka.
nice.
It's in the spirit of January. It's 0%. So
That's very good. And I've got a decaf latte as well in the spirit of January. So
have you got any New Year's resolutions, Hughesy? I listened back to last year's episode that we did, which we did in room 3-2.
Did we?
Yeah. Your New Year's resolution for 2024 was to spend less time scrolling on your phone. How did you get on with that? Failure.
Probably,
Good.
I was probably slightly better than the year before. I listened to a lot of podcasts and audiobooks this year, or 24.
Probably
which
better
actually,
than doom scrolling Instagram.
yeah,
isn't it?
I think that was a good habit. I haven't really got any New Year's resolutions.
No.
Maybe to be a bit more glass half full. I was a bit negative last year. I
Yeah,
think.
bit Eeyore.
Yeah, I was a bit Eeyore. I like Eeyore. No, I don't. I think it was a good year last year. You got any New Year's resolutions?
I've signed up for a half marathon. You like this? It's only 6 weeks away. So that's focusing the mind on trying to run 20 odd kilometres, or how far it is. Is it? How many kilometres? 21. 21. Oh, God.
Yeah. Should sign up to Runner, which is a good.
Yeah, you said
fitness
that.
app.
Okay.
RUNNA.
Right.
I cycle with the
No
guy
free ads
that developed the app.
Oh, right.
He owns a business, yeah.
We've got some more holidays booked, and I think that's a conscious thing. So obviously we're going skiing.
We are. With the boys.
I've got a trip to Italy booked. Oh, I'm not allowed to say that. And we're going to Corfu in the summer, and we're going to try and get something else in around either Easter weekend or half term in May. Just nice to do a few more things, right?
It is as the kids.
Only get one chance.
It is as the kids are growing up.
Otherwise, no real resolutions other than the kind of classic: be a better human being, be a better version of yourself, Hughesy. But I mean, in terms of like years, I mean, it was a good year for markets, right? But I think a lot of people think it was a bad year because the politics was quite messy. We had an election, we had a budget, we've got Trump, we've got a lot of clients have been quite unnerved by everything that happened last year. That's kind of my general view.
I think, I mean, we've had 2 cracking years in terms of equity returns, but I don't think we feel particularly. I don't think we feel as positive as perhaps we should do after 2 great years of. I mean, it's been a good bull market, but
it doesn't feel like a massive
it doesn't.
mega bull market.
And I think,
I guess if you're American, you probably would feel like you're in a mega bull market because you're sort of immune to some of the other things that are going on in the world.
Yes.
And the returns have been even better.
In every developed market election last year, there was a change in government, which I think was all down to inflation. So I think the reason we don't feel very positive is because inflation has eaten away our returns.
Prices are roughly 25 to 30% higher than they were on the eve of the pandemic. I mean, it's interesting. The eve of the pandemic it's 5 years now. So if you're looking at like performance of how your investment's done, it's 5 years since December 19. And 25-30% is the kind of hurdle rate for standing still, which is extraordinary.
Yeah, I do think returns feel good, and there's obviously been wage growth. You know, most people's salaries have probably gone up.
Yeah, should have done. Should have done,
definitely. But I think most people's, particularly sitting in the UK or Europe, I think our spending power has probably fallen.
Most people has, in general.
Yeah.
The Next had numbers out this morning. I know we talk about Next quite a lot, don't we? Two of us, because Next is a kind of classic UK bellwether retailer because it sits squarely in the middle of the market. It's not budget, it's not luxury, it's the middle of the market. And the numbers were good. Stock's up 2-3% today. Sales growth last year 6%. They did, however, say that their wage bill per year is, I might get the numbers wrong, so I might caveat this, but I think it was 950 million they spend, and that number is going up by 70 million this year.
And that's in national insurance?
Well, some of it's national insurance, some of it's national minimum wage going up, but because the minimum wage is going up, they have to put everyone's wages above them up. So if the minimum wage was 10 and you had someone who was slightly more senior on 12, if the minimum wage goes to 11, that guy on 12 needs to go to 12.50, 13 to keep the gaps. So like the minimum wage has pushed up everyone's wages all the way up the scale. So 70 million is quite a big number.
But then that should feed. Well, you said
some of that goes to the exchequer in national insurance, but some of that does go through to wage growth.
Which means there should be a bit more
spending in next. But we've got a good chart on that later on, haven't we, Hughesy? So we'll get cracking. Good. Good afternoon, everyone. Sorry, slightly delayed start to things today. Welcome to Taking Stock After the Bell. Happy New Year, and welcome to 2025. Got it right that time. We thought we'd, as we did this time last year, we thought we'd critique Hughesy's New Year's resolutions from last year, and we thought we'd run through what happened in markets and the world last year, and we can do any predictions for this year?
You're going to do predictions. I did predictions last year. It's your job this year.
Predictions are hard, especially about the future. So we'll get cracking. I think the major story of the last 5 years, really, as we've talked about, and it's sort of rearing its head again a bit, isn't it, is inflation. Inflation in the UK ended the year at 2.6% on CPI, US CPI 2.7, European CPI 2.2, pretty much normal, right? We don't have the chart in the pack, but core CPI sits a little bit higher than that, doesn't it? It's still pretty sticky, coming down a bit slower. I think inflation perhaps has come down a bit slower than we might have thought, but for all intents and purposes, 2.5, 2.7% is pretty good compared to what we've been used to for the last few years.
Yeah, I think if we'd said in the middle of 22 that by end of 24 CPI would be what's UK 2.6. I think we would all be absolutely delighted because there were lots of doomsdayers saying it was impossible for inflation to come down to anything like that level quickly.
The oil price has done a lot of heavy lifting, hasn't it?
It
I haven't got
has.
an oil price chart, but it's right back at $70, so it's not got to 120. And we'll all notice that when we go and fill our cars up, assuming we don't have electrics yet. And because inflation's come down, interest rates fell through the year as well. So basically in the US and the UK we had 2, if not 3, rate cuts. UK rates at 4.75 come down by half a point. And in the US rates are at 4.5%, come down by 3/4. So they've had 3 rate cuts in the US. Which is not as much as the market expected last year. This time last year the market expected rates to come down by 1.5%, and they've basically come down half of that.
Was that 6 cuts?
6 cuts was priced this time last year, and we only had 3 effectively.
And do we think?
Well, the market's gone back the other way now, so the market now only thinks we're going to have 1 or 2 cuts this year.
Yeah.
And I wonder we might have a bit more than that. But
do we think central bankers did a reasonable job last year?
I think so. I think the Fed, what did they cut first in August, didn't they? I think they might have cut in June, July.
Yeah.
But they were too late raising rates. I mean, hindsight's great, right? They were too late raising rates in 2022. 2021, and they were too probably fractionally slow to cut. But as we will see, the US economy.
We had David Mortlock on, and I remember the cut was coming that night. Was that a bigger cut
August.
than we expected?
Yes, that was the half a point.
That was the half when he felt it should have been a quarter. There wasn't the need for it, and actually he was probably right.
Yeah.
Because everything's sort of slowed a bit since then, hasn't it?
Yeah.
And inflation is a bit stickier.
Core inflation in particular in the States has not come down as fast as people thought, and there's potentially it ticks back a little bit higher. So we'll see. I mean, my very simplistic view is that unless the oil price goes bananas, we're not going to see a return to 4, 5, 6% inflation rates. Like, you have to have a big oil price spike. So people talking about inflation still in the system, well, energy prices are the basis of all that. It's not happening. But anyway, we'll see how it goes. Certainly there's a bit more price pressure around, as we've talked about, with Next and wage growth and people having a bit more money in their pockets. I mean, this is a chart really that kind of is dispiriting if you're a UK or European resident. So this is GDP in absolute terms for the US in yellow, UK in blue and Europe in grey, and we can see obviously the massive fall 2020 as we turned the economy off, we turned it back on again, and essentially European UK growth is flatlined in real terms, whereas the US growth has kind of carried on its pre-pandemic trajectory.
And why has that happened?
Well, the war in Ukraine had a bigger impact on the UK and Europe than it did on the US because we were closer to it. Energy prices took more of a bite out of our
and took confidence away from us.
Confidence, industrial production's fallen quite a lot, particularly in Europe. Talk about car manufacturing, etc. Exports are down. Yeah, confidence is one of those things. But the reason we've got a fiscal black hole in the UK and the reason that the French budget is a disaster is because growth hasn't been strong enough. I'm somewhat loath to use the phrase, but maybe Liz Truss was onto something when she was wanting to try and stimulate growth, and that had the UK economy grown in line with its pre-pandemic trend, we probably wouldn't be in this position, would we? Because the pie would be a lot bigger. So
the lines seem to separate around 2016, 2017. What happened?
The lines
then?
seem to separate around 2017. Yeah, no, you're right. They do. The US has grown better since this is a pre-pandemic issue. I think we might need to get Simon French back on to discuss this.
Actually, that's a good point. Yeah,
he'd be very good on this sort of stuff.
But it is I mean, our GDP fell the most.
15%.
Europe wasn't quite as bad, but the US, I mean, it was
Barely
a reasonable fall. But is that helicopter money that was put in, or
yeah, probably deficits and checks. What do they send out? $1,000 to everyone?
That's more than that.
Was it?
I think it was almost $6,000 a family, wasn't it?
It was a lot. I think that whole helicopter money, fiscal expansion probably helped a lot on the GDP, and they've run larger deficits in terms of their government since then as well, and they're still running a larger deficit than we are, which might be, talk about this year, one of the risks, and we're seeing it a little bit in bond markets, is that the world decides to not buy US treasuries anymore because there's going to be so many US treasuries issued. Bond yields have gone up and they continue to tick a bit higher. We've got a chart a bit later. That would be my kind of number one risk for this year. Coming back to the economy, and this is amazing. UK versus US retail sales, and again since the pandemic, UK retail sales are unchanged, and US retail sales carry on going up.
Yeah.
US households and US consumers are spending money. UK consumers are not spending money.
And this is pure confidence.
Well, I think so. And the flip side of this, US consumers are spending. The next chart, US households are saving. US households are saving 4% of their disposable income, and UK households are saving 10% of it.
Yeah.
So that is the gap.
And
that is confidence.
And this was one of the discussions, wasn't it, when we had the general election, and it's how the Labour Party were going to instill more confidence in the UK person, and essentially spend some of those savings, and they haven't done a great job so far.
No.
I mean, the election was all around a pro-growth agenda. We had the live webinar following the election. Following the budget with Adam, and there was very little in there to stimulate, and that I think that would be my. That's all of our worries. Is we can see what the sales are doing, we can see what savings rates are doing. How do we get more confidence in the UK consumer? Try to spend some of that cash or invest it or put it to work.
So the kind of good news here is that UK household savings are high, and therefore, if some confidence came about somehow and they started spending some of that, the economy could look a lot stronger, a lot quicker. Mm-hmm. Like the fundamentals are pretty sound, right? There is money there. People's wages are growing, as we've discussed. But a lot of it, I do think post-election, the kind of narrative that came from government, it's going to get worse before it's going to get better. Got a £22 billion black hole. Taxes are going up at the budget. What's the average household going to do faced with that level of... And then, of course, they put national insurance up. And you don't need to be a rocket scientist or particularly bright to work out that companies paying more national insurance is ultimately going to hit households in the end somehow. So it doesn't take a lot to reverse this narrative, but it does need some bit of positivity. Wouldn't go amiss, I don't think.
No. Also, people worried about whether they'll have a job or not, because companies are making cuts because of extra expenses, then savings, if they're in a position where they can save a bit more and save a bit more, then they probably will do to protect themselves.
Agreed.
There definitely needs to be some confidence put in.
So that's the glass half full bit.
Yeah, I'm going to try
As
be
ever.
more positive.
My view is that the UK could outperform because expectations are so low, and therefore it wouldn't take a bit of confidence and things get going a bit. And we've talked ad nauseam about how cheap the UK equity market is. So again, confidence instills itself in that way as well. Now, how did investors do in 2024? Well, despite the electoral rhetoric and politics, diversified investors did pretty well. So these are the snappily titled MSCI PIMFA indices, and there is a growth, a balanced and a conservative index. That's the three lines on the chart. Most clients would kind of class themselves as balanced investors. On this index, it's a growth index. It's not necessarily the best comparator, but the balanced index was up 10.7% for the calendar year. Growth investors made 13.7%, so that's pretty good. Conservative investors made 6.1%, which for a conservative investor, it's not great, it's not disastrous, right?
No.
Generally speaking, most clients made kind of near double-digit returns.
And that's in an environment where gilts didn't really do what we hoped for them to do as well. I think if rates had been cut as much as we expected, then the protection within the portfolio would have done better. So I think bearing in mind that, well, in reality, equities were the very large driver of all returns, weren't they?
Which leads me very neatly onto the next chart, Hughesy. So if we break down the two main asset classes, the yellow line here is the MSCI All Country World Index, so the global stock market. That was up 20% in sterling terms. UK equities, which is the blue line, were up 9% on the year. So UK did quite a lot worse than the rest of the world. Corporate bonds made you 2%, and gilts were actually down 4%. So if you owned the gilt index, which is some quite long-dated gilts, which you might not necessarily own, but still the index was down 4%. So you're right in terms of that balanced index. Most of the return came from equities.
I think European indices were up. They were similar to UK. They were up about 9.5, weren't they?
A bit less, I think. 5 or 6 in the end. But I think UK did better than.
I'm looking at Eurostock 600, which
sterling was up against the euro, wasn't it?
Good point. Yeah.
So that probably done some of your return. But from this chart, standout performer really was global equities. And if we break global equities down on this chart here, the yellow line this time is the US. In sterling terms, the MSCI US index was up 27.3%. I mentioned the UK was up 9%. I've got that data here, Hughesy. This says 10 for Europe. MSCI Europe X UK.
That's in dollar. No, that is in GBP.
That is in GBP,
yeah.
So, I mean,
I thought Europe was slightly. It had a bit of a kick at the end of the year, didn't it, compared to the UK?
Yeah. Oh, sorry, I got this wrong. So EM is up 10% and Europe was up 2.8%. Is that right? Yeah, the dark grey is Europe, isn't it?
Yeah, it's weird. Here I've got.
That'd be sterling. That would be a dollar number.
Okay.
Anyway, the too long didn't read. US equities were the standout again, and everything else was pretty mediocre. And if we then zoom in on the US return, courtesy of our friend Ross Yarrow at Baird, he's got this somewhat more colourful chart than I've managed to produce in my time. This is the attribution of the US equity market. So the US equity market was up, call it 25% during the year.
Yep.
The Magnificent Seven, which we've discussed ad nauseam, contributed 13% of the 25. So 7 stocks over half the return. So if you didn't own any of the 7 stocks, your return was materially worse. And of that contribution, we can see the biggest one was Nvidia, which was 5%. So a fifth of the US equity market return was from Nvidia alone. Apple second biggest, then Amazon. Meta, Google, Microsoft and Tesla. Of those 7 stocks, only Microsoft did worse than the market. So they all outperformed except Microsoft. So we talked about it a lot in the pod, but it was the year of the magnificence again.
It was unbelievable. And actually, bearing in mind Microsoft was probably a bit disappointing compared to what we expected, and it's such a big constituent. Actually, despite that, the 7 still gave a huge amount of performance.
Well, we talked about it with Ben Barringer on episode 44, didn't we? Which we released on Christmas Eve. So for those people who haven't listened or watched that, there's some good stuff in there about the tech sector in general, from which all of these companies pretty much come from. And there
was multiple expansion, but a lot of the return came from earnings growth and revenue growth. I think the question a lot of clients will have is, can this continue, or what looks different for the year we're now in? But if revenues and earnings keep growing, then the shares can continue performing.
Okay.
I think probably our expectation is there's probably some broadening out, and there's other names that look equally interesting that aren't on the same multiple, or actually earnings are starting to come back and looking more interesting. It's not just about the 7, it's about the other 493 as well. But I think the setup is still okay. If you look at earnings estimates,
I guess if we were sat here in a year's time and this 7 again contributed half the return, and the return was good, if we're in the same position today as we next year as we are today, I'd be pretty worried. Yes. I think.
Yeah.
So from that sense, it will be kind of healthy to see something
it would be. But I think if you look at earnings estimates for the rest of the markets, I think the estimates are better going into this year for the other 493 than they were last year.
Correct.
And part of that is there is a bit more confidence. Inflation is a different level to where it was. The cost of debt has come down, so for the slightly smaller businesses, that will be beneficial to them. It's easy for Apple and Microsoft to go out and borrow money, but for a smaller 500 company, although it's still huge, it will be slightly more expensive, so that makes a difference.
The gap between earnings growth and investing 101 in terms of equities, earnings drive share prices ultimately in the long run, and if the earnings growth of Apple, Nvidia, Microsoft is higher than the earnings growth in the rest of the market, we would expect those share prices to do better over time. And that's exactly what happened last year. The earnings of the Magnificent 7 grew so much faster than the rest of the market. I'm going to say the rest of the market grew at 3% and the Mag 7 grew at 20 or something. I mean, the numbers are really, really wide. But I think this year, most estimates are the gap is a lot smaller.
Absolutely.
I think it's like 12 versus 8. But
still, it is exactly that.
But they are magnificent for a reason, and they are growing quite strongly.
What would make us more comfortable is, for earnings to beat estimates, but for that multiple to come down. So the companies grow into their share prices, and you saw some of that throughout the year, but then as Nvidia announced new chips and other businesses, and you sort of saw the growth from Meta and in the AI potential, markets get excited and share prices grew further at different times. But Nvidia's had another. I think it's given back some of the gains today, but it had it's had a good start to the year.
Really good start to the year.
And I think Jensen announced some new chips yesterday.
I mean, don't look at me for the detail. I mean, he made some speech and said something about some new chips. I mean,
that's what Ben's here.
Ben's not here, so we can't ask him about it. We'll ask him tomorrow morning in the morning meeting, though. I mean, it was like 2024. Investors did well. But where did that return come from? Predominantly, a large chunk of it. If you didn't own a lot of the Magnificent 7, you probably didn't make 10%.
No, and I think in 2024 again was a year where active investors struggled to beat the market, and it's pretty easy to explain that, because to have an overweight position in some of these companies, it's very difficult, because some UCITS rules restricts the maximum position you can have in a fund, but also to have an overweight to Nvidia, you have to have a very large percentage of your portfolio in that company.
Particularly if you want a meaningful overweight as well.
Exactly, exactly. So I think over 80% of active managers underperforms.
Well, the majority. I don't know exactly what the number is, but the majority underperformed for
but
sure.
It won't. Our expectation is for broadening out, and you would expect in that situation, active managers have a much better time of it.
Yeah, no, totally agree. So we'll see. I'm sure the Magnificent Seven will be a topic of conversation as the year goes on, but we'll wait and see. Bonds, 12-month chart of UK gilts, US 10-year treasuries, and German bunds. Yields, UK in blue, yields started the year at 3.5%, end of the year over 4.5%. Whoops, not good. And today they've gone up a bit more, 4.6. Oh dear, 4.7. So
I think this is probably my biggest disappointment of the year was what gilts did. So I think we sort of went into early 2024 with the expectation of lots of
rate cuts.
Lots of rate cuts, and for the first time gilts were yielding really healthy levels, and we expected not only good coupons if they were the gilts we were buying, but also some reasonable capital return in that environment, and actually it didn't happen. And
the opposite happened.
Yeah.
How often does that happen? So if you're buying a UK 10-year today, you're getting 4.6%. Like, we've had the election and the budget, and that has had an impact. But this idea that UK gilt yields have gone up because of Rachel Reeves, is wrong, because yields everywhere have gone up. So it's a global phenomenon. Japanese yields, should have put that on as well, having been 0 to now 1% or something, over 1%.
But maybe that's take the other side of the coin, which is as a starting point and a setup. We're buying. You're buying very reasonable yields in gilts. The risk-free rate is very good still, actually. If gilts had performed as we thought and yields were 3.5, 3, the setup wouldn't be as attractive.
No, of course not. Your return on a gilt is literally what you pay at the start. So if you're now paying 4.5 and you own it for 10 years, you get 4.5% a year.
Yeah.
Now, if you assume that central banks do their job and inflation only averages 2 to 3, you're getting a positive real return. And it's the first time you've been in that situation for 15 years since before the crisis, right?
Yeah.
The risk of buying a gilt here today is that yields go from 4.5 to 5.5, 6. Well, my contention would be that if yields go up meaningfully enough for you to lose money in capital, because you're starting with 4.5% of coupon, so if yields go up by 1%, my contention would be that the equity market ends up doing worse than your bonds do.
Yeah.
Because as we saw in 2022, the equity market does not like it when bond yields go up over a certain threshold, and the market has a hissy fit. So I don't know. I mean, it feels like you don't necessarily need to buy 10-year gilts, but if you're buying 2 to 5-year gilts at 4.5% yields, I think you'd be okay, wouldn't you?
Absolutely.
It feels like a sort of decent way to lock in.
Protection.
It's not. I mean, it's not the most exciting takeaway from today, is it? But funny one for bond markets, and of course the flip side of this, of course, is we've got Trump presidency starting. We've got Rachel Reeves trying to balance the budget here. The more the gilt yields and treasury yields go up, the more interest governments have got to pay on the existing debt, which means issuing more debt. So the black holes and the fiscal deficits start to look a bit worrisome once yields start going.
And we've got a reasonable amount of US Treasury issuance this year, haven't we? It'll be
Massive
interesting
amount,
to see what appetite's like for Treasuries, particularly as going back a few years, the largest or one of the largest buyers was the Chinese government. With that demand falling away, I mean, I have no doubt there'll be plenty of appetite still, but it'll be interesting to see where it comes from.
Yep, no, agreed. That is going to, and again, to come back to the point I said earlier, like the one risk I'd have for this year is that we have a whoopsie moment in the bond market, a la Liz Truss, but on a slightly grander scale.
It's definitely something to
we'll see.
Think about.
Couple of other look at alternatives. We've got commercial property and commodities. So commercial property in blue, this is a UK commercial real estate index, a REIT, not good, particularly at the end of the year. And again, that's a function of interest rates. So when interest rates go up, commercial property prices tend to go down on a sort of yield basis. Commodities made a little bit of money, but not a lot in sterling. If we look into commodities, the oil price was flat, agricultures were down, but gold was the kind of winner, wasn't it?
I think gold was up over 25% over the year, wasn't it?
In fact, I think gold beat US equities last year.
Did it?
In sterling, yes. I saw that chart. Ross had that chart. So somewhere else. We haven't put Bitcoin on. Alex is smiling. He's a hodler. So yeah, Bitcoin the winner as well. So I don't know. I've got nothing interesting much to say about these two.
No, it's strange that. Well, I do get it that you know, real estate is incredibly sensitive to interest rates, but we were starting from a pretty low base again, weren't we? To see that index down, I mean, that's
created in the last quarter.
It's just down over 15%.
Well, Segro's down a lot, and that's the biggest constituent.
Yeah.
It's a yield play, isn't it? It's sort of higher for longer interest rates.
Yeah, but it didn't exactly have the kick the other side. That's what's slightly concerning.
I've actually forgotten. I've got a gold and oil chart here. So oil is in blue, unchanged on the year. Started the year at $76, got to 90 in March, got down to 70 in September, ended the year at 75. This is Brent. I think that's Brent crude. And today it sits at 77, so it's up a little bit year to date. The gold price there in yellow, and as you can see, it's gone from $2,000 to $2,600 at the end of the year. So a very strong year for all things that glisten, and I've mentioned Bitcoin already. So that's pretty much that, really. So yeah, I mean, you know, generally a good year, but in order to have had a good year, investors needed to own US equities in size, right? But
I think what's probably worth remembering as well is, you know, that was off the back of a very strong 23 as well in US equities. And I think we probably felt, along with a lot of other strategists, that other regions could perform quite well. And that didn't happen for various reasons. But this is why we run diversified portfolios.
Absolutely right.
You know, we've got the protection in there, we've got multiple region exposure, you know, we've got home bias because we sit in the UK and we've got a bit more UK than world markets would have, but there's lots of reasoning rationale behind that. But yeah, it'd be interesting to see what the US does again. That's definitely what investors are watching closest.
Yeah, I mean, sort of for the people out there who are very much like the Mag 7's in a bubble and it's all going to blow up, my sort of view is slightly be careful what you wish for, because if those stocks are overvalued and they fall 25%, then you know portfolios are not immune. The rest of the market isn't magically going to cover up those problems because they're so big. What is it? The top 10 stocks in the US are now 40% of the US index. Like the Mag 7 are a massive weight in the index. So just like if those stocks do roll over hard because Nvidia isn't changing the world or AI isn't a thing, which we don't think is the case, but like you sort of map it out, I don't think portfolios are going to be immune from that, and that'll be pretty bad news all around. I
think the other thing, you know, there's been lots of commentators trying to compare the current environment to the dot-com bubble. And as we've discussed before, it's very different. There are real earnings and there are real revenues, and there's real investment going in. It's not, you know, we're not changing the name of a company and sticking .com on the end of it.
It's .com.
It's,
you know, AI at the end of it.
You know, AI. I mean, we can see it from our own working practices that AI is having, you know,
positive impact on what we're doing.
It is, and we are changing the way we work as a result of it. And it is Copilot is a very useful tool, and we will use it a lot more going forward.
ChatGPT I use regularly. Perplexity.
Yeah.
Use all of them. Apple Intelligence. I haven't got a new iPhone yet, but the new Apple Intelligence is supposed to be pretty good, which is the ChatGPT inbuilt into it. So yeah, I mean, it's not the same as the .com. No.
I think probably what I would expect is that in 2024. The biggest buyers of Nvidia chips have been the hyperscalers. I think, or we sort of feel, other businesses will start to buy those chips and develop other applications and softwares. So the buying of those chips will change. I think, who knows if Microsoft and Amazon keep buying and Meta keep buying in the same quantity, but I think that buyer mix does change. And we discussed this with Ben, if you remember. I think Saudi are spending over 3% of GDP with Nvidia on chips, aren't they? It's
a big number.
Yeah, it's huge. So I think that does broaden. I think there's going to be lots of opportunities in other areas or other businesses that we might not even necessarily be aware of at the moment that are utilising that technology. So as always, there's plenty of opportunities.
I think we haven't touched on politics really, have we? We've got inauguration next week, a week after. The tariff talk is back. We had kind of some news on that yesterday, and Trump's pretty adamant he's going to slap a load of tariffs on. Trudeau's resigned in Canada.
Yeah,
it's not unrelated, I don't think.
No.
Peter Mandelson's been made UK ambassador to the US, and then
Musk is having a go at UK politicians.
Musk
I don't understand why.
Politico this morning, the email I saw suggested that there's already a bit of a rift between Trump and Musk about certain things, which isn't surprising in the least. And it's going to be a pretty bumpy year. But the thing about Nvidia selling chips to China, and all of a sudden the US government stopped letting them do that, like the geopolitics is going to start to impact on some of these names now, I think, and on markets in general. So we have to be somewhat alive to it, and I don't think we can bury our heads in the sands about it as we have done for the last 10-15 years, because it's all been pretty quiet on that front. So that's another sort of dimension to markets this year that maybe we haven't been used to since Trump was last president.
I think actually we had this very strong equity rally from when Trump was elected. I thought it was actually quite good to see a bit of a sell-off at the end of the year. I thought that was quite healthy. And although the markets have been, the market was okay yesterday. There's a small correction, a small sell-off today after some data. US data's just been released, but I think it's quite good. We're not off to the races.
Agreed.
We're waiting. We'll see what the inauguration brings. We'll see if his bark is worse than his bite and what actually happens. But there's a lot for us to digest and the market to digest. There's a lot of unknowns at the moment. But ultimately, if you look at earnings estimates for the companies we invest in, they look pretty positive, and that's the case for 26 as well. So we obviously work very closely with our equity analysts and regional analysts. For the moment, we're quite comfortable.
Ultimately, the economy is growing at 2% in the US, 2.5%, and nominal growth, because that's a real number. You add inflation on top of that, 2.5%. You get nominal GDP of 5 to 6%. Therefore, companies, whether it's Coca-Cola or Apple or whoever, should be able to grow their sales at that 5 to 6% rate at a minimum, and that does translate into 7 or 8% earnings growth, 10% earnings growth. So it's very difficult to be down on equities as an asset class if you're owning the great companies of the world. What's on my list? Apple, Intuit, Meta, Nike. These are good businesses.
Starbucks.
Got a few problems. Starbucks. Yeah. So if you own those businesses, ultimately it's kind of almost not irrelevant, but you focus on the bigger picture, which is the world keeps turning, growth is fine, people are spending money, wages are growing, and the economic fundamentals look pretty sound. We've talked a lot in the last 2 years about recession. We've not had one. Maybe this is the year we've had one. Maybe if we don't predict one, maybe we will have one. But, things look okay, so we shouldn't be too kind of worried. There's always things to worry about, and there's always reasons to be doom and gloom.
I think there's less to worry about today almost than there was, certainly 18 months ago, because inflation is in a very different place.
Yeah, I agree with that.
There are, it is probably stickier than we'd like, and there are. We're looking at natural gas prices, weren't we? That were creeping up a bit. There are segments that there's a bit of a wobble over, but on the whole, it's I think a far better investment landscape than it has been for. 24 got much better, but certainly in 23 we were worried about lots, weren't we? It was keep calm and carry on.
As I keep saying, the world has changed. If you are worried about the world, you can buy high quality short dated bonds giving you the best part of 5% return. So if that can be your base default, which wasn't the case 3, 4, 5 years ago. So in that sense, you've now got options, and I've been banging on about this for a couple of years, but the landscape has genuinely changed for the better for investors. And hopefully the great companies of the world will carry on doing what they're doing.
So what else happened in 24 that haven't covered? Do you think we've run through everything? You
ran a few. You did a few cycle races. Fell off your bike a few times.
I did. I lost some skin, elbow and knee. Got more races this year.
Good to hear. Other than that, it was nothing particularly major in the Raymond household.
So what are your predictions?
Predictions for another solid year, with some wobbles along the way. There you go. How does that sound? I mean, I'd be surprised if the US equity market does another 25%, but
Yeah.
as we often say, the more we do this, the less surprise we get about being surprised. Because lots of stuff happens that we can't really predict, and you're like, wow. So,
very good.
Have diversified portfolio.
Maybe we should do a
Don't look at it every
podcast
day.
special from the Norwegian chairlift.
Norwegian chairlifts, yeah. We'll look forward to that. That might be the highlight of definitely the highlight of the first quarter. Certainly more of a highlight than my half marathon. Should we call it a day, Hughesy? You got a train to catch, haven't you?
I have. No, that was good. It was actually. It's quite good to run through exactly what's happened, because you get caught up in the noise, don't you? Actually, to look back and look past what's happened over a year. It's quite interesting to see where we come from.
You can get Copilot now to listen to the recording of this, and then they can write your email to clients.
Oh,
your roundup email. It'd be good, that.
I can do my annual review now. It's done.
Or you can just send an email with a link to this saying, if you want to know what happened, just watch this. Thanks very much, everyone, for watching and listening. Any questions, get in touch with james.hughes@courtachieveit.com or jonathan.raymond@courtachieveit.com, and we'll see you next time. Thanks very much. Bye-bye.
Thank you.